Good afternoon, everyone, and thank you for joining today's webinar presented by Altfest Personal Wealth Management. My name is Jesse Frailing. I am the Director of Retirement Plan Services here at Altfest, and I will be your moderator for today's webinar. The title of our presentation is Doing Well While Doing Good, Investing for a Better Future, with a focus on impact and sustainable investing. We wanted to thank our clients and guests for taking the time to attend the presentation. We are so glad that you have tuned in today. I would like to introduce today's speakers, Ben Lake and Steve Novack. Both Ben and Steve are the lead advisors at our firm when it comes to researching sustainable investments for Altfest clients. Both Ben and Steve are also certified financial planners and have deep experience implementing sustainable investments as part of an individual's comprehensive plan. Today, Ben and Steve will discuss a number of topics, including the current and evolving landscape for sustainable investing, the challenges that exist, as well as Altfest's unique approach to sustainable investing. We will finish with a Q&A at the end of the presentation, and if you do have questions during the webinar, we encourage you to type them into the chat box inside the webinar box on the right-hand side of your screen. We will do our best to answer all questions live during the webinar. However, if we do not get to your question, we will certainly follow up with you over email. And with that, I will turn it over to Steve Novack to begin the presentation. Steve?
Thank you very much, Jesse. Thank you for the introduction. And I wanted to thank all of you for joining. I know we originally planned this about 6 months ago, but glad to see that there are people who have come to join and listen. And waited all that time for this topic to come. So let's talk about sustainability, ESG. You see on the tree right here, there's a lot of different names: impact, environmental, social responsibility, green. These are all terms that are kind of interchangeable and can be used going back and forth. Sustainability is the term that most people think about when they think about socially responsible investing. But nowadays, the more common name is ESG, which stands for environmental, social, and governance. This sustainability is part of the environmental piece of that. We'll give a little further description when we get to the next slide. But first, let's give a brief history of, nope, back one slide, please. Let's give a brief history of just sustainability and how it has come about to the point that we are. It dates back all the way to the original books of the Bible that are followed by Christians, Jews, Muslims. There's talk in there of how to treat people, animals, and even some guidance on business. But in the modern day realm of sustainability, back in the early 70s, around 1971, two Methodist ministers were looking to invest their church money, and they wanted to, make sure that the funds were not being contributed to the Vietnam War. And the first fund was created that actually made sure that they had screenings to prevent the money from going to the Vietnam War. Later in the 80s, anti-apartheid movements started making sure that people were divesting South African positions to make sure that the money wasn't going into the government and helping to repress the people. Later in the 80s, in 89, around March of 1989, Exxon Valdez spill up in the Alaskan Bay created more issues and more calling for corporate responsibilities. I personally was kind of involved in this. I was working for a maritime law firm starting that year, just about a month before that happened, who was eventually hired by Exxon. They were a lobbying firm in DC to help create their image with the government. So I had 3 years of experience working on that case, and kind of helps you form some of your, moral judgments later on as that was going on. But from those, the apartheid and Exxon Valdez, there were a lot more international summits that came about, creating larger groups and drew more attention from more companies, countries, and social groups. Eventually, the Kyoto Agreement that happened in Japan came about, and that was to I think it was about 170 countries came together. Not all have signed it, but the idea was to reduce the carbon emission. Then that led to further UN summits, economic developments, and other protections to try and help countries improve their investments, their energy, and the air, the land, the sea, everything around them. Kofi Annan later in around 2000 created the Global Compact Initiative. This was a voluntary group that the corporate citizens brought together to try and create common rules for human rights, environmental, labor, anti-corruption principles. The term ESG, which we will talk about in a few seconds, actually came from this, this compact when they were describing it. Around mid-2000, there was something called the Principles for Responsible Investing. People might have heard of PRI or UNPRI. This is part of the UN itself that came together with it. There's 6 core principles. One is to make sure that investment analysis and decision-making takes ESG issues into account. You incorporate ESG issues into your practices and policies of the firm. You disclose on ESG issues of your company itself. You promote acceptance of the principles within the investment industry. You enhance the effectiveness of others to help them implement the principles going forward. And you report on the activities of how your company is progressing with you following these principles. There's an annual meeting at the UN on this, and actually last December, I actually attended it. It's a little over 1,000 people. People from all over the world come in, get a lot of senators, representatives, just local business people who, speak throughout a 2-day event to try and continue to promote the principles that are there. Now let's talk about ESG itself, and let's try and give you a little more clear definition of everything that's included in here, because this is a lot broader than just the sustainability that we were talking about. E is environmental. So that's the sustainable piece that what we normally think of: greenhouse gases, emissions, biodiversity, waste management, water management. But sustainability is what? It's the depletion of resources, diminishing of raw materials. It's making sure that the long-term view is taken into account and that people are thinking about that. The other piece that typically when you think environmental, the bigger name right now as opposed to just sustainable is climate change. What are we talking about climate change? We're talking about what we can do now to try and prevent a warmer world later on. The view is that the benefits of earlier actions, will outweigh the costs that we're incurring now because it will save money in the long run. So those are the pieces when you think of sustainability that originally started this. And as that was developing and kind of maturing, they started adding some other areas to talk about. So next we're going to talk about social. Social is, within the companies that we're talking about how, I'm sorry, not within the companies, external to the companies itself. We're talking about diversity, making sure that when you're bringing people in, you're looking for a broader pool of talent. There are case studies that show that the larger pool that you bring people in from, the more you don't end up with like a common thinking guideline. You end up with people who will show difference of education, difference of upbringing, and that will enact a better thought process when the company is trying to have open discussions about products and new things that we can talk about. Next, social human rights. In 2006, the US Court of Appeals ruled that companies' social responsibility squarely can go into the financial arena. So that means that social responsibility becomes more of an important piece to the company, that they do have some responsibility, that people can be held, things can be held against them for failure to do so. That's the health and well-being of employees, looking into the corporate supply chains, the companies that they're actually getting supplies from, consider the impact that they have on local communities. For work that they've done, if they are, creating factories and polluting the area, well, that's part of what they should be thinking of. Consumer protection, assuming most people know, caveat import, I'm sorry for the pronunciation, but buyer beware. That is something that was brought through centuries, and everyone had to think about it. Well, that's also changed a lot. There's a right, people are now finding that there's a right to a degree of protection from the companies that they're hiring. People are doing damage litigation against the companies if they fail to do something or take actions to prevent a harm, whether to the environment, to a person, the consumer. It could be in many ways. Central consideration here that we're talking about is seeking to limit the company's risks. So, consumers and the companies are trying to work together to try and make sure that not only the consumer protected, but so is the company protected from, lawsuits. Social, animal welfare, testing of products on animals, breeding of animals for market, making sure things are taken care of on a humane or more humane way. And that kind of sums up the social aspect. Next is corporate governance, and we're talking about more internal vehicles that were within the companies themselves and how they actually handle their own corporate responsibilities. So diversity of a board we're talking about here, how the companies manage. The management structure, something that's very different between the US and Europe. In the US, the president and the CEO typically, I think it's about 75% of the time, is the same person. In Europe, I think it's about 20%. And that creates a diversity of opinion. So there's more conversation going on to make sure things are more balanced. So that's something that people are looking at, how the management structure is done itself, who reports to who. Can be important. If an audit committee reports to the president, well, that's not as good as if it reports directly to the board of directors, which is where most of the time it does now, but years ago it didn't do that. Employee relations, diversity of establishing, corporate behavior rules, make sure people are, engaged in talking to each other, talking about issues. How do you recruit? What's the best way to recruit? Where to recruit? What type of, questions do you ask? What type of testing do you do? And all this has a noticeable impact on the company's values and how the people who come in want to be there. Forbes puts out a list every year of the top 100 companies to work for. People want to be on that list, and it's kind of important. So some of these things are where you want to be and where you want to work on. Executive compensation, that has become a larger issue also recently. There's much more, reporting of how much a corporate officer makes, what type that compensation is allocated to, whether it's stocks, options, cash. The idea of a clawback has come out in recent years, which was unheard of, let's say a decade ago. That has become more and more. Even employee compensation, equal compensation, race, gender, doesn't mean anything what's going on. People who are doing equal jobs are earning equal pay. There are a lot more pay audits going on. Some companies are even making those public to see what's happening and how that goes. Next slide, we're going to start talking about how the screening has gone. We're going to go back a little bit to more of the sustainability and talk about how it originally was done. This is all talking about negative screening, which is an easier way to screen for products or screen for investments. Here, you're simply excluding certain things that you don't want. You want to invest in products that will claim to do no harm. So you're getting out of tobacco, fossil fuels, companies that do animal testing. But the idea of just simply doing that doesn't necessarily weed out all the companies that you want to have. And as you push this further and further, then the question is, what's next? So, okay, now companies don't get involved in those certain areas. Well, then you're kind of talking about trying to make improvements, not necessarily just prevent them from doing something. And then that's kind of where we start talking into something else. Here, it's a question of do no harm, so you're not going there. Well, now let's talk about a positive screening where we're actually trying to improve what's going on. So on the next slide, we have positive screening. This goes a further level. So not only are we talking about, we're not talking about the simple restriction of not having certain actions, but now we're talking about actually looking for companies that are doing things right or helping them do things right. The idea of ESG, or what now a term that is used a lot, is impact investing. So it's not a question of just having say not having the oil, we actually want to now engage with companies and help them improve. You're not looking for a company that is perfect. You're looking for a company that is doing right, but has room for improvement. And some of the mutual fund companies that we have high levels of engagement where they actually go into the companies, help them to improve the company, either help them disclose it, help them make changes, talk to them about issues that they do have. And they're finding that that improves value. So positive screening, when we're going through it, we're looking for, let's say, a best in class. So we're going to start looking at different aspects of a company and start rating them. How is the diversity? And this goes back to the ESG scenarios that we were talking about when we're talking about internal or external. How are their employee relations? How is their executive compensation? How is the board set up? What's their record on human rights? How's the diversity of the employees? How's the diversity of upper management? Their record on consumer protection? Do they have a lot of lawsuits? That's what we're looking at for this. But by doing positive screening, what's the downside of positive screening? Depending how rigorous you make this, you can actually you can limit your pool that you can select from a large group that negative screening would allow you to a very, very small level. So that's why I was saying it's not always easy to do this and make sure every company is perfect. People are willing here usually to take companies that do have some limited downside and work with them to try and improve that aspect of the business. Next, I'm going to start talking about a couple case studies that we have and show, how has impact been done. This is a case. This is talking about Colgate-Palmolive, and they were getting their palm oil, from down in Indonesia and Malaysia. About 85% of the world's palm oil comes from there. And they were starting to get some pressure, and they started realizing what it meant to be on the ESG platform and to have this. And they made basically a pact. They came up with 6 principles of their own for their company and what they were going to do. And those principles were to prevent deforestation in high carbon stock forests, which meant forests that were absorbing a lot of carbon. They were trying to make sure that they were engaged with conservation values of the area. They would refuse to allow anyone who was using fire to clear the lands to grow more palm oil to be a provider. They prevented the use of any peat lands, which is basically like a decaying vegetation into like a peat bog or something. That happens to be, and I did not know this until I was reading all about this, that this happens to be the largest and most effective way to sink carbon into the earth naturally. The reduction of greenhouse gases in the processing of the palm oil, and to make sure that they were not exploiting the locals, people, or the communities to generate this. And they hired independent third parties to verify this and produce reports to make sure they were doing it. And their goal was to make sure that all their palm oil was derived from sustainable processes this year. This has been a few years in the making, but this was a perfect example and something that, because it was, I think, checked off this year, came up in my research that I thought was a great example to show you. Next one is now talking about building of buildings. This happens to be something close to all of us. This is up in Yonkers. This is a pediatric nursing home that was built, I think, about 10 years ago. It's about 170 beds, over 200,000 plus square feet. And the goal here is to make these kids, originally started off as really young pediatric. Now it's, I believe, from basically birth to about 18 that people can live here. Make them have like a sense of community. Their bedrooms are designed like normal bedrooms. They have neighborhoods, so they grow up with the kids that they have, family rooms, play areas. They have a TV room. And each neighborhood has, let's say, about 30 to 40 kids, so they can feel a sense of community even within the larger building. When this building was built, they used certain building criteria to get what is called a LEED certification. LEED is an outside company. They use independent verification, and they do more than just buildings, but I'm going to talk about the building aspects. They have a set of criteria that you would get evaluated on. And depending on where you are in the on the list of the checklist of about 100 items, you can get different certifications. This happens to be the first gold building for a hospital. Gold is not the highest, it's the second highest, but to be a gold is pretty substantial. So what are some of the things that they look at? Reduced energy and water usage, lower operating costs, lower construction waste, reduced liabilities when they're going through more durable buildings, so less work, less maintenance. They want to make sure it supports the local economy, greater resale value. All of these things are, improved air quality. All these things go in. And as I said, there's 4. You can be certified silver, gold, or platinum based on the review of the independent party. Excuse me. So why this is going, you can get this certified at the initial onset, and then you can continue a certification, continue that on an annual basis as the building is in existence. Make sure you maintain the level of certification you have, and you can go up and down within that. Next slide, please. Excuse me for that. So now let's talk about what's going on in the marketplace with the funds themselves. The funds you can see have been, this is now the number of ETFs and open-ended funds, mutual funds that have been opened in the United States over the last 15 years. You can see over the last 5 years, the number has greatly increased. In fact, in the last 5 years, almost double the number of the prior 10 have been introduced. This is, it's a trend that just keeps going. We don't see this slowing down. The next slide that I have actually has the dollar amounts. So we'll just go to the next slide, please. Thank you. So this is now showing the investments that's coming in. The investment over the last 10 years, you can see that's $20 to $50 billion a year. But the last 2 years, I'm sorry, that's not 20, it's $5 billion a year, with a total of about 50 billion since from 2009 to 2018, we didn't break the $100 billion mark. In 2019, we had approximately 20 billion come in just within the 1 year. And the total assets under management now are over 200 billion. And then in this year, in year-to-date 2020, we're almost at an equal amount, which is an amazing thing to say. The US alone on this is still relatively far behind. While we're talking about 200 billion or so in the US, Europe is over $1 trillion right now. Their ESG funds definitely have been drawing more money. It seems to be a more dynamic event going on there. And I'm sure we will follow them, but if for some reason it's caught on much quicker, much faster, I think when it comes to following, energy and clean air policies and stuff like that, they have been a little bit ahead of us. We have more space, and we have not moved quite as fast. So that's the quick. Oh, there it is. I didn't see the general understanding of what's going on. Next, I'm going to turn this over to Ben, and Ben is going to start talking about more the investment side.
Thanks, Steve. That was tremendous, and I think it's really fascinating and important to understand the history of how impact investing and sustainable investing has grown over time, how it's evolved, what is included, and what is to many people now, especially on the investment side. And as Steve just mentioned, the amount of attention being paid to this particular area has grown dramatically in the U.S. In the last several years. And it's grown to a much more robust part of the investment landscape now, which is something that is great for investors like us, our clients, and certainly, as Steve mentioned, as we catch up to other parts of the world who've been doing this for a bit longer, something that can really propel us forward. And so what I'd like to transition to now is talking about some of the challenges that we face as investors in the sustainable investment landscape. How we at Altfest approach finding solutions to those, and then how we might implement a truly sustainable portfolio for our clients. And so to start off with some of the challenges that investors face, the three, I think, main things to mention here are, the perceived historical performance sacrifice, right? There's this concept that, going back in history, if you wanted to have sustainable investments as part of your portfolio, you may have to deal with lower returns than, a traditional benchmark or a broader benchmark. And so we're going to address that momentarily. The second main challenge is something called greenwashing, which is a relatively new term. Well, it's been around for some time. But what that really refers to is, as there's been more and more products out there, investment managers coming into the space, people kind of saying, yes, I'm sustainable, yes, me too. To what degree is that genuine? And to what degree is that maybe not really the case? Are they doing it just in name only? That's what greenwashing really refers to. And then the third one is, how do you measure the actual impact of the investments that you're making in a sustainable type investment? Certainly all three very different, but significant, but I think there are solutions and ways to address each of them. And so to address the first one, this perceived historical performance sacrifice, what we've done is we've looked at various benchmarks in the past, and there's a study illustrated on the next slide here that shows if you look back at the last 7-8 years or so, and what's been happening with a traditional group of investment companies versus an ESG focused benchmark, with basically a tilt towards companies that are performing better on the environmental, social, and governance metrics that Steve outlined. How have they compared on these main metrics here on the left? So annualized return, right? How much return are you getting? Volatility, right? Basically an annual measure of risk. Sharpe ratio, which I would define as basically how many units of return your investments are getting per unit of risk. So it's a measure of risk-adjusted returns. Maximum monthly drawdown, right? How bad was some of the worst months? And then ESG score, right? How much more environment, social, and governance friendly are the companies in the ESG focused group versus the traditional cohort? And what you see here now is that in this time period in the US, there actually really wasn't any performance sacrifice. And obviously this is just 2012 to 2018, but this has continued in the last couple of years, where the ESG focused group of companies has actually slightly outperformed the traditional benchmark. And the same is certainly true this year for a few reasons we'll get into a little later on. But you can also see that that slight increase in return is also met with relatively similar volatility as well. Again, a very small difference there. Similar Sharpe ratios, but you are able to pick up at the bottom there a significantly higher ESG score. So really kind of starting to see that, at least within the US, investor returns are roughly equivalent. At least they have been so far. Now, the same is actually true to an even greater extent in the international space. So this next group of benchmarks that says World ex-US, this is looking primarily at developed international markets, Europe, Japan, etc. You can see that there's a more significant, but still relatively modest increase in returns with roughly the same level of volatility, level of risk. And so that goes in line with something Steve mentioned earlier, which is that places like Europe, places like many parts of Asia have been more focused and doing more on the ESG front within each country, within each company, in all these indices, to a degree that investors have been rewarded for supporting those companies. And again, that's continued. And interestingly enough, one of the areas that people ask us about the most is what about in emerging markets, where it's perhaps more difficult to see a country like China or India break its reliance on traditional coal power and move into more renewable sources of energy. It's a very common question, but interestingly enough, there's actually the most stark difference between returns in the ESG focused emerging market companies versus the traditional emerging market companies. A much greater increase in returns there with, again, very similar volatility. And so you have an increased overall risk-adjusted return experience there. And at the bottom, you can see very significant increases in the ESG score compared to traditional benchmarks. So there's a bit of a myth busting that's been going on over the last few years. And certainly that's continued more recently this year in particular, as certain areas that are much lower weighted or completely excluded from ESG benchmarks are areas like traditional energy, right, oil and gas, many parts of financials, for example, and certain industry groups like airlines. A lot of those have greatly underperformed the benchmarks this year, obviously for the reasons that are mainly related to the pandemic that's been going on across the globe. But certainly that's been one of the factors that's been in favor of these ESG benchmarks and styles on an ongoing basis. And so it's been very helpful to see that. Of course, it remains to be seen how that continues going forward, but given the way these trends have continued, from the amount of attention being paid to these areas, the amount of dollars flowing into sustainable investments, and the increased global focus on these types of factors, all point towards brighter futures ahead for these types of styles and investments. The next main challenge, again, is greenwashing. And as a just broad definition, I think it's helpful to basically state that what we mean by greenwashing, or what this is in reference to in this particular case, is essentially having a company or a product or a fund manager claim that they are doing something that benefits the environment or benefits other types of sustainability concepts or beliefs, but those claims are just not really true, right? They're just unsubstantiated or flat out misleading. And this has become more and more common, unfortunately, as you saw in a previous chart, that great increase in the number of ETFs, mutual funds coming into the space that claim to be sustainable, that claim to have a sustainability focus. Not all of those are truly doing what we as investors would expect them to be doing in terms of making an actual difference within these kinds of beliefs. And so this is one where it takes a bit of an extra level of research and due diligence to be sure that any given investment you're making really does reflect the values you're trying to espouse with your investments, and also achieve the investment goals that you're looking for. And so one common way that we start getting into what is truly a sustainable fund versus a greenwashed fund is getting into things like, well, what about the impact you're making? What are you doing that's active in the ESG space with your investment companies? And how do you measure the impact of what you're doing? And that gets into this third challenge here, which is, again, measuring the impact. How do you measure the impact? It can be very difficult to say that, oh, well, I've bought a couple stocks here and I got a couple bonds there, and tying that to an actual end result is something that we've certainly demanded of the managers we partner with, and that investors, I think, are generally looking for, but it's not that simple. And so because of those demands, because of those requests, we have seen more and more asset managers and government institutions try to address this problem. And here's a great example. This is a company called Access Capital, which runs one of the funds that we invest in on the fixed income side of the Altfest Sustainable Portfolio. What they do each year is release what's called an impact report. And that is their way of trying to basically track exactly how many end results occurred because of the investments they made. And so they've been able to make impact investments in over 49 states and the District of Columbia. They have all these metrics here for how many low to moderate income home buyers they've helped become homeowners. How many affordable rental homes have they created or constructed? Same thing with nursing home facilities, small business loans, promoting minority-owned businesses, producing more and more ability and opportunity for people to both create places to live, create places to work, and start businesses. These are all the different ways that they're able to track exactly how they are creating that impact that we're talking about here. And there's more companies doing this. Is obviously just one example, but hopefully as time goes on, additional resources will be put towards this, more asset managers will start being able to do this, and it also will then lead into more and more individual companies, right? The end companies that each fund manager is investing in, generating this type of information as well as they report to their shareholders. And that relationship is certainly a very important one, because really what we want to see from the types of investments that we're making with these fund managers are, do they actually say what they're going to do in terms of making sustainable investments? How do they reinforce that? And then how do they measure it? And how does all of that translate into a great investment for our clients? And so that, really ties into how we at Altfest approach creating a sustainable investment portfolio that achieves these multiple goals and overcomes, these main challenges. Right. So our focus really starts with finding managers and companies that are making a positive impact with the way that they are making their investments and allocating their capital. We're not just starting with a negative screen and saying, okay, it's enough that you're excluding tobacco or fossil fuels or anything like that, right? That's really not necessarily enough for us. We want to go a step further. And certainly that's been easier to do where possible, right? Not every single asset class or kind of niche opportunity has a manager who's been great in this particular area. So by and large, we are able to find great options, and create very diversified portfolios that achieve that. And so that's where we're trying to focus. When it comes to using that portfolio and implementing it for any individual client who is interested in this area, we want to first start with their goals and their risk tolerance so that we have a closely matched asset allocation and risk characteristics between their sustainable portfolio and their core or traditional portfolio, right? Because of course, everything that we do at Altfest is really very much about focusing on what are the client's goals, how is anything that we're doing helping them achieve those goals in the most risk conscious, smoothest way over time. And so that ties in with our final main principle here, which is that we do always want to prioritize good investments over just the highest impact, right? Again, there is still a reason to be somewhat concerned that if a manager is great at focusing on sustainable issues, but they're not great investors, does that really mean they're helping our clients as much as they possibly could? Maybe, maybe not. And so that's why we say we want to prioritize good investments over just the highest impact managers. And there's a bit of a difference when it comes to implementation between the multiple asset classes in a client's portfolio. So for example, looking at the equity side of a sustainable portfolio versus the fixed income side, there are two kind of different things going on in terms of how those dollars are really making an impact and what it might mean to the overall portfolio. And what I mean by that is, if you're the owner of a stock, right, the owner of an equity, you have some voting right, some ownership and control over the company, right? It's very minor, generally speaking, but you have the ability to exert some kind of influence over the decisions the company is making. And so, one common thing that we do when talking to our sustainable managers on the equity side is ask them how they're voting in shareholder meetings. Are they making any proposals to management to help adjust their behavior or do something that's more beneficial for the ESG principles that we've been discussing today? Or are they simply just kind of being more passive and letting them do whatever they want, but just using it as maybe just screens, right? That's one major difference between an equity manager conversation versus a traditional non-sustainable equity manager conversation. On the fixed income side, you don't necessarily have the same amount of control, right? You don't have ownership in the company. Technically, you're really just lending a company or a government money with the expectation of it being repaid over time with interest. And so you don't have the same kind of voting rights, ability to influence decisions. So what you're really trying to do there is create a more affordable opportunity, perhaps, to fund a certain project, to fund things like, again, affordable home ownership, or a city or state that's trying to build out a new sustainable water management system, right? Those are kind of very common types of fixed income investments that are going towards sustainable projects. And in addition to those kinds of things, you may also be simply making it more, again, cost conscious from the borrower's perspective by offering additional, investment dollars so that they can achieve lower interest rates, right? If some project comes up and it's not as attractive to the traditional bond investor, but a sustainable bond manager comes in and says, well, this meets our mandate. We'd like to add these dollars, to the bonds you're auctioning off. That may make it affordable for the borrower to actually do the project and get things started. And so you're really doing two sort of slightly different things, but both work together to create that broader impact while maintaining obviously a very diversified portfolio. And so when we have these conversations about implementing these portfolios within a client's total investment picture, what we generally say is that for many clients, it's not necessarily all or nothing, right? We'd actually rather people start with a portion of their portfolio dedicated to the sustainable investments, something on the order of 10 to 25% to start out with, see how that goes, see how it compares to the traditional portfolio, the core portfolio that they have. And part of the reason for that is so that they can get used to how that performs. If it's different than a core portfolio, it's also generally a good idea to have both in order to make sure you have as much diversification as possible, certainly in case things go differently than we expect. And as a firm, we do try to minimize the overlap between the core portfolio and the sustainable portfolio. There is some, because generally we think that many of the investments that we're making in both portfolios are just very good investments that really everyone should have. So there is going to be some, of course, but we don't want there to be too much, right? We want there to be a better blend if someone has both portfolios. And then when someone is actually making the actual allocation, sorry, I'm back on this previous slide. Thank you, Jesse. For actually making that transition, creating the portfolio and funding it, there are certain things to consider, like if you're using a taxable account to fund a sustainable portfolio, you may need to consider what the tax implications are of buying and selling some of the investments, especially if things are at significant gains, as they may or may not be this year. And there also is a generally recommended minimum investment threshold for these types of accounts, because we do want to make sure that if you're starting a sustainable portfolio, you're able to get each of the positions in sufficient size that you can have, again, you can ensure diversification and minimize the overall impact of things like trading costs, if there are any. So generally we recommend people start with somewhere between 60 or 75,000 at the low end as a minimum threshold for starting a sustainable portfolio. So we try to make it as feasible as possible for clients of any size, really. And now, so with all of that said, I also wanted to provide a bit of a market outlook, because one potential follow-up question is, well, should I be looking at these sustainable investments now? Should we wait a bit? What's happening? And of course, these are all very good questions, and this is kind of a very good time, very challenging time to be asking those kinds of questions. So, with the term market outlook, I could be here talking for the rest of the week, and we could be here far longer than anyone intended. But I just want to address a few things that are more specific to this conversation today. So, first of all, I think if you're considering sustainable investments now versus later, generally speaking, trying to time a transition like that isn't necessarily going to bring any advantages or disadvantages, right? I think generally speaking, if this is an area you're interested in, it'd be great to just reach out to your advisor, talk to them about starting an allocation, increasing an allocation, decreasing an allocation, whatever it may be, and kind of have that conversation, because it should be more about your goals and what you're hoping to accomplish, right? Things like your values, as opposed to any kind of market timing, which we know, generally speaking, isn't a successful overall strategy. Now, that being said, obviously, I'm giving this particular slide or presentation a week before a major election, right? And things could go very differently depending on the outcome of that election. And so, I think from a very broad level, starting at the kind of the top and working my way a little bit more detailed, overall, I think that the trends when it comes to sustainable investments are very positive, right? As we've described, both Steve and I, saying that, the amount of people who are focused on the space, the amount of companies trying to do better within ESG type principles, the amount of governments who are increasingly making promises to reduce things like carbon emissions, improve social equality, all of those types of things point towards, again, a very strong potential future long-term outlook for sustainable investors. So I think overall, anytime you choose to be looking at this, it's generally, I think, a very good conversation to be starting. In terms of what's happening right now in the marketplace, in the stock market, in the bond market, here in the U.S., valuations do look somewhere between fair and slightly high on average, looking at just the broad indices. And a lot of that is because of obviously the very strong rebound we've seen over the last several months. Obviously, there's been a bit of a pullback this week, so maybe things are a bit more fairly valued at the moment. But nothing is necessarily a slam dunk instead of in terms of being or looking dirt cheap here. But if you look in other parts of the world, you actually see that overall valuation levels are actually quite below average compared to their history in places like developed international markets and emerging markets, particularly in places like Europe and Asia. And so there are certainly more potential opportunities globally, which is again why we focus on making global investments and then maintaining very good diversification within all of our portfolios. But that's the same thing here with the sustainable portfolios. Now, bringing it a bit more to the short term, I think that as it pertains to sustainable investments, some of the things that have been debated in the political sphere recently are quite different between the Trump administration and the Biden potential administration. Certainly in terms of one of the major impactful areas like potential stimulus measures that might come through after the election. Right? There's been a kind of second round, if you will, of fiscal stimulus that's been debated within Congress, within the Department of Treasury for the last several months. It's very recently announced that whatever they're going to talk about is only going to happen after the election. And so it definitely remains to be seen how any potential stimulus package might unfold. However, with a Democratic win, especially if it's not just the president but also Congress, if there's Democratic victories that kind of create a majority in both the Senate and the House, that will likely mean that there's more willingness to spend on things like infrastructure that is geared towards sustainable investments. They've certainly talked about that much more openly and much more specifically than the Trump administration, where a stimulus package may involve more direct payments to individuals, slightly less in terms of infrastructure, or it could be potentially more focused on other types of sectors, right? As opposed to sustainable infrastructure, perhaps it goes more towards traditional energy, even coal industries, things like that. So it may mean different things in the short term, but overall, those things don't necessarily make a massive impact for that longer term trajectory that I mentioned. Again, because the future of the next 10, 20, 30 years have certain, I think, kind of undeniable mega trends that will be much more impactful, much more significant than anything that just happens in the next few weeks or months or even the next year or so. And so with all of that said, I want to pause, make sure there's enough time for the audience questions. But before we get to that, let's just wrap up by saying that, today, I think we talked about quite a lot. This is a very broad space, often misunderstood space. And so, the key takeaways here are that sustainability, impact investing, this is an area that's been growing more and more rapidly. The amount of investor demands for investments and funds in this space has been growing, and significantly so since 2019 over the last 2 years. And that's likely to continue in our eyes, especially as we in the US catch up to other parts of the world. That perceived historical performance sacrifice seems to now be a myth, right? Going forward, unclear as to if that's going to continue, but certainly over the last 7, 8, 9, 10 years even, there really hasn't been any kind of give up in performance, and certainly very little difference on the risk side. So it's actually potentially a better overall investment space for investors. And we at Altfest, we're really focused on that positive impact being made by the investments we're making within our sustainable portfolio. So if you're interested in this, if you're interested in including the sustainable investment portfolio into your overall investment picture, we all encourage you to reach out to your financial advisor here, start the conversation, continue to express what you're interested in, what your thoughts are as well. And with that, I'll throw it back over to Jesse, and we'll field any questions that the audience may have.
Thank you very much, Ben, and thank you very much, Steve, for an excellent presentation on impact and sustainable investing. I think that was a terrific overview of the landscape, as well as Altfest's unique approach to the sustainable investing environment. We did, as we transitioned to the Q&A portion of our presentation, we did have a number of questions that came in. So thank you to everyone who submitted questions. The first one that we received is, what motivates companies to increase their commitment to ESG? Steve, maybe let's start with you.
Sure. Well, let's talk about what motivates a company to do anything. I think companies are starting to realize that it's not just about personal values, that people are starting to do more with their voting, with their dollars. So they're looking to increase the value of the company by taking on some of these challenges and making some changes, which sometimes can be costly. Sometimes a lot of them are not. They're not that big of differences for them. I think they're realizing they're attracting more consumers. I think that's very important. Part of that also, Ben mentioned about the bond financing. If you start working on certain projects, you can go out and actually find things at cheaper rates. These green bonds that exist allow you to participate. So you might be looking at two different projects. Well, one you can finance at, let's say, 7%, and the other one you can get 4% financing. Well, that just made the one that has a 4% financing a much more attractive scenario for someone to go into. So it still is a money concern. Are they looking short-term, long-term? A lot of these things are more long-term. It's not, quarter by quarter, but looking out in the future. And I think Europe has realized it a little more than we have, but I think we're coming around, and you'll see more of this coming in the next few years.
Terrific answer, Steve, on what's motivating companies to implement ESG today, certainly. The next question that we received is, what other types of things do sustainable investment managers focus on beyond environmental issues? Ben, let's go over to you.
Sure. So I think there's quite a few. Obviously environmental issues are one of the main focuses and are one of the main headline grabbers. But as Steve mentioned, it actually wasn't the first. Right? It started out with religious principles, and more recently has grown to include the S and G of ESG. So all those social and governance issues that we talked about earlier. I think a few of the primary examples that I mentioned in client conversations are things like, from a governance standpoint, just making sure that there's adequate racial and gender diversity on corporate boards. Right? It's not only just like the right thing to do, but it's actually been shown in numerous studies that it actually improves decision making and improves strategy, and so actually winds up being better for the company overall. So certainly that's something that's become more and more important over the years. I think maybe especially this year, as there's been such a big push for more and more inclusion. Another one that Steve had mentioned is actually pay equality and adequate, I think, incentives up and down the entire corporate structure, right? So not just like gender pay equity, but also massive differences people have seen in the past between CEOs and maybe hourly workers. So kind of going top to bottom again through the corporate structure. Those kinds of things really reflect the overall corporate culture and actually have a direct impact on things like how many employees actually stay at the company over time, right? What does turnover look like? And what does that mean for overall business results? And so all of these things that started out with just kind of like, good, just basic human principles actually have a measurable impact on the future performance of each individual company. And so I think those things are in many ways, as important as the environmental concerns, depending on the kind of company we're talking about.
Thank you, Ben. Third question that we received: how are companies being kept in check to ensure they live up to their commitments? Steve, I think this piggybacks nicely on the previous question related to what is motivating companies to increase their commitment to ESG. So why don't we go back to you for this question?
Sure. Let's talk about engagement. A lot of the companies, the mutual fund companies, are engaging with the companies they're investing in, talking to them. This is what I discussed earlier. I'll give you a perfect example. Last year, I went down and I visited Calvert, which happens to be one of the fund companies we use. Calvert is owned by Eaton Vance, who just got bought by Morgan Stanley. but they are a truly dedicated ESG company. They invest, all their funds are in this world. They went out and actually engaged in shareholder proxies with 16 companies. I believe the year, I went there last year, so it's probably 2018 we're talking about here. But they brought proxy votes up to the shareholders for 16 companies, 12 of which were withdrawn because the companies agreed with them before they ever went anywhere. 3 were voted on and voted in, and 1, I think, was voted down. That's a pretty good track record. They're going in, excuse me, they're going in to bring this engagement in. They want to make sure these companies are not only following what they want, their principles, but they're making sure that people are aware of them, bringing it to the attention of other shareholders, and trying to make sure that they can, convince the other shareholders to vote their way. Another sample of this is even like the UNPRI, which I discussed earlier. I learned it was interesting because the UNPRI actually is a self-reporting belief as of right now. Their goal, and a little bit different strategy, is they're trying to get as many companies to sign up for it based on self-reporting, with the intention of getting so many companies in here and then changing the strategy to actually have them agree to be monitored. So, this has only been around for about a decade right now. They're still trying to get enough buy-in so they feel they have a large enough potential. In the last few years, a lot of the larger banks have started to sign on for this. Are they following it right now? They're saying they are, but I think what will happen is that you're going to be required to get an external audit to prove that you're following these principles. And I think that will be the second step of how they're going to try and keep in check. But the UN wanted to, when they came around, they wanted to make sure they got the people brought in first on the self-monitoring, as opposed to them worried about whether they could really actually do it, and get their buy-in for upfront and then make the change. I'll stop my answer there because I do realize we're near our hour, and probably the last thing stopping everyone from grabbing dinner.
Well, thank you, Steve. And we have reached the end of the questions that we have received anyway, and we are coming up on close to 6 o'clock here. So with that, I want to thank both Ben and Steve again for an excellent presentation. I also, of course, want to thank all of our clients and our guests this evening for attending the presentation. As always, we hope you found it to be interesting and informative. And if you do have questions that you didn't have time to ask or think of later, as always, we encourage you to reach out to us. Thank you again, everyone, and have a great rest of your evening.